stock market ended quarter four higher, but the path included periods of volatility. In October, the S&P 500 ended its 5-month winning streak, with most of the equity market finishing slightly lower. The sluggishness occurred as Treasury yields rose after the Fed's first rate cut in September, suggesting the sharp rise in yields may have played a role in October's market action. However, stocks rebounded in subsequent months. In November, the quick and decisive election outcome became a tailwind for stocks. Investor enthusiasm fueled the post-election rally, with stocks trading higher in anticipation of tax cuts, deregulation, and U.S.-focused trade policies aimed at benefiting U.S. companies. Small caps led the way during this broad market rally, with the Russell 2000 rising 11% in November to set a new record high. Bank stocks were another popular post-election trade as investors priced in expectations for financial deregulation and strong economic growth. Industrial stocks saw broad-based strength in anticipation of the Trump administration's pro-growth policies and protectionist policies, which could spark an industrial renaissance in the U.S. At the end of November, the S&P 500's year-to-date return passed 26%, putting the index on track for gains in consecutive years of more than 20%. But in December, the market's excitement cooled, with the S&P 500 trading sideways and ultimately ending the month low. Beneath the surface, a familiar trend from earlier in the year impacted returns, with smaller companies underperforming larger ones by a wide margin. The Russell 2000 index was hit the hardest in December, falling 8.4% and giving back most of its post-election gain. Value stocks also traded lower in December, with the Russell 1000 Value Index declining by 6.8%. In contrast, with most of the market falling in December, the Magnificent Seven stocks that we discussed earlier actually gained more than 5%. Now, shifting focus to global markets, international stocks underperformed U.S. stocks in quarter four. The MSCI Emerging Market Index returned a negative 7.2%, while the MSCI EAFE Index of developed market stocks returned a negative 8.3%. Both of the major international equity indices underperformed the S&P 500 by nearly 10% in the fourth quarter due to currency headwinds, i.e. a stronger U.S. dollar, and the outperformance of the U.S. megacap. Looking ahead to 2025 for international markets, the potential tariffs under President Trump is creating significant uncertainty across several global regions. As a standard disclaimer, this video is for educational purposes only and is not intended to be financial or investment advice.